live.
Hello, I'm Andrew Haslip from Global Data's Wealth Management Division. I'm head of Wealth Management Research and Asia Pacific, and I'll be taking you through some of the findings that we've gone through for some of our more recent research since COVID-19's outbreak and the effect it's having on wealth managers around the region. So first off, wanted to just kind of set the scene a little bit here with just some figures from the OECD. So basically what we got here is quarterly GDP growth quarter on quarter, and a broad kind of consumer confidence index from around the world. So obviously, just important to note, obviously we've had one of the more severe contractions in living memory, but also one of the severe contractions in consumer confidence. And while we have seen a little bit of a uptick in terms of consumer confidence over the last couple of months, as you can see on the green line there, you can also see that it's not going up dramatically. And so that's really a kind of a context, I think, for the conditions that wealth managers are finding themselves in, even in Asia Pacific, where the effects of the crisis have abated a bit. So first off, let's give a little comparison of how regional savings and investments are supposed to grow or anticipated to grow over the course of the year. As you can see there, Asia, of the three major markets three major regional markets that we're looking at, still expected to grow, along with the Middle East, for instance, as well, and Africa, that market. But just of the three majors, there were three with appreciable amounts of AUM there. You can see that Asia is really the only one who's eking out decent, or at least a positive growth rate this year. Compare that to what happened in 2018. You can see we're not expecting quite, 2008, we're not expecting quite the same dips as we saw then, but that's really much more apparent, I guess, in Europe and Asia Pacific rather than the North American market, where the scale and scope of the decline is roughly the same. A couple of big things. The reason why that we're anticipating Asia Pacific to continue growing overall, even though there's quite a few of the smaller markets there that are going to suffer quite a bit, is largely due to the stabilizing role that China now plays. When you consider the size of China in the Asia Pacific market compared to what it was in 2008, it's almost like night and day. It's really quite a difference there. So that's one of the good things, really. And of course, there is a much larger role for deposits in the general kind of makeup of the savings investments market across the region than there is in other regions, particularly North America, where they're much more invested, even to quite a lower level at the wealth tiers than we see there. Now, and speaking of the wealth tiers, when we take a look at what the different wealth tiers are doing through the crisis, you do see that there's quite a different experience depending on where you sit, essentially. So we are anticipating that the high net worth market is going to be hit the most in 2020, and that's really due to the larger exposure that high net worth individuals have to kind of variable securities and such and all that. Whereas if you go down the wealth tiers, there's much more of that kind of deposit role in there, and obviously non-liquid assets that aren't budging quite as much. There will be a big bounce back, of course, in terms of 2021. We're anticipating quite a robust growth rate, particularly in the Asia Pacific region, obviously. So like almost 20% growth in assets to the end of 2021, really. So that's what we're basically seeing is a bounce and a little bit of recovery once vaccine kind of gets into play, as it were. Once again, just kind of like examining the breakdown of assets by band here, you can really see that there is a lot of ballast, I guess, in the lower levels, preventing some of the contractions that we see in some of the higher levels, particularly deposits playing that big stabilizing role. So in markets where there has been substantial government support for for incomes through the crisis. There was actually a bit of an uptick really in terms of savings in markets where obviously, and this is a bit more applicable to Asia Pacific, where there was not quite as generous support from the government. Obviously that some savings have been run down, but generally speaking, that's a stabilizing role for the lower level of those tiers there. Now, when we look at, so all that discussion that I just did was more focused on the onshore picture, on the onshore kind of experience. When we look at the offshore wealth management market, obviously we're looking at a bit more of a rarefied view of what's happening. We're definitely looking at more of a high net worth view, whereas when we're looking on domestic onshore stuff, we're looking definitely more across the entire wealth spectrum then. But when we take a snapshot of as to how the offshore market was faring going into the crisis, it was doing pretty good actually. We've had 3 years of growing AUM in the offshore market, globally speaking. As you can see on that black line there, there was a growth rate for 3 years prior to. What we're expecting for 2020 is another growth, although the FinCEN kind of releases and all that might result in a bit of a pullback in terms of high net worth willing to book offshore, and at least into some offshore markets. And since the U.S. is by far the number one, that might affect the overall growth rate overall. Just some key trends there. Asia Pacific had been growing its share of the offshore market quite nicely over the last little while. And when you look at so that's the bar chart there. When you look at where Asian wealthy families are sending their money, though, there was still a big look in for outside of the region. So U.S., U.K. being the top booking centers for Asian families looking to book abroad, and the number one reason still for offshoring. Offshoring wealth is business interests and better returns. So none of that secrecy stuff anymore playing a big role at all. So encouraging, but still probably some room to be made up there. And then in particular, if you look at the individual markets of Asia Pacific, so where people are booking to and from in the market. So when we look at Australia, for instance, just as an example, the major offshore wealth coming into the market still dominated by the UK and US, though there's definitely an increase in terms of Asian wealth coming into Australia, for instance. So Hong Kong's increased its market share, Singapore, Japan's about roughly even, and obviously China's increased as well. But as a share of the stock of wealth invested into this market, still, the traditionals are still dominating that quite a bit. So the UK and US there, and then we look at kind of the flip side of things, where Asian wealth sends their money just at a specific level. So looking at the Hong Kong market there, just obviously there was a lot of interest over the last little while for that market. You can see there's still a good look in for booking centers outside of the region. So you got your US and UK there, but obviously China's coming up quite a bit. That has dipped a little bit from 2015 to the end of 2019. Obviously, there's some issues there geopolitically speaking, but generally speaking, overall there has been a slow, at least modest increase in the share that Asian wealth markets are getting. So in particular, I just want to highlight the growth in the share of Singapore. So this is Hong Kong wealth going into Singapore, booked into Singapore as an offshore center. So just kind of interesting that has grown over the last little while, and kind of bears out some of the anecdotal kind of evidence and stories you hear about some of the wealth exiting to the Singapore market. Now, just looking at a kind of a bit of a scene setter for how the industry entered COVID. we're actually quite encouraged by the state of play for a lot of the wealth managers, looking at their 2019 reports and looking at their half-year reports overall. So they entered the crisis in pretty good nick, honestly. There have been a steadily decreasing cost to revenue ratios, which is always increasing or always encouraging. And the growth in AUM was quite pronounced. Obviously, 2019 was a really good year for the markets and a really good year for wealth managers as a result. But inflows were up over 2018, and so was the obvious market performance. So unlike the last recession, major wealth managers kind of came into this one looking pretty good. We do anticipate that overall there will be a slight negative in terms of the growth in AUM for the year, and that will obviously impact, particularly in the second half of the year, revenues for wealth managers. And so we don't anticipate there's going to be much savings in terms of cost, even though there's obviously some variable cost built into the private banking and wealth management model. We really do see that there is a lot of opportunity to cut costs there. So another increase in the cost to revenue ratio is absolutely expected. Crucially, though, you look at that, and the retail bank, the business bank, and all that would love to have that kind of ratio, I'm sure, going into the end of this end of the year. So we do think that the wealth management arms and the wealth management industry overall will look comparatively extremely attractive for any financial services player or any players looking to get into the industry, as we've obviously talking a lot about outside players looking into wealth management as a possibility to grow their businesses. So wealth management will look attractive, particularly going towards the end of this year and into next year, I'm sure too. So that's obviously an issue. When we look at the very, very top end of the market as well, so this is another area where there's a considerable difference between what happened last recession, global recession, and what's happening this time. So if everyone could remember, the big names of the business really last time around were the ones who are suffering the most. There were huge outflows at some of our Swiss providers there, and just generally damaged reputations all around. That's not happening this time around. When we do examine the books of business that the leading wealth managers in Asia Pacific had at the half-year mark. This is, of course, global growth, because a lot of them don't split out their regional performances at the half-year mark. We can see that they're faring quite a bit better compared to what the rest of the regions are doing and what the rest of the wealth managers are doing. So there's been only marginally down in terms of assets for UBS, the market leader in Asia and around the world. And there's even a few players out there like DBS and JP Morgan, which are up on their 2019 figures. So that's pretty impressive overall, and really, I guess, kind of highlights the ability for the big brands in this time of crisis, in this time of change, to kind of be a comfort to high net worth wealth. And then this is strictly looking at the private wealth management operations rather than the more broad operations of some of these players. So really quite interesting story. And the reason why we do highlight that's quite a significant improvement and really quite noteworthy is the fact that we do see a big shift in investor appetite for risk and retention issues going into any crisis and any recession. So we've been surveying the market and surveying the region for quite some time. So we look back to kind of our survey results for the GFC and just the post GFC recession. We do see a big drop in demand for risk. So there's on the right there's a 10 point drop there for risk appetite. We do see increase in churn experienced by most wealth managers at that time. So loyalty to the wealth manager goes down considerably, and a big demand for hand-holding and kind of reassurance in that demand for face-to-face contact as well, which is obviously something that's been a struggle in social distancing when you can't do face-to-face as much, particularly during the lockdown period when markets were in free fall, and it was very difficult for relationship managers to provide that TLC to keep their clients invested and all that. So yeah, so that's kind of a global trend, but you can see, yes, it's exactly what our Asian wealth managers are reporting to us in our survey as well. 67% are seeing a drop in risk appetite. Only 8% report an increase. 71% seeing a drop in retention rates as well. Obviously not quite as bad at the top of the market, but yeah, something to keep in mind, and just a kind of a scene setting for some of the challenges that wealth managers are facing in the region. Speaking of challenges in particular, so we couldn't do a survey of private wealth managers in post-COVID lockdowns without taking a look at and getting a feel for where they felt the kind of risks and threats were to their business model overall. So here we've just divided the sample by region, looking at some of the big kind of responses and threats for wealth managers overall. And you can see basically the pink line, Asia Pacific, is not, I mean, they see threats, and obviously there's more than half the market reporting threats and all that, but they're not necessarily as concerned, as worried about a lot of these as you're seeing in the other regions. So obviously North America, not surprising. So our US obviously skewed towards the US in our sample and all that. Big concerns about the financial market downturn and the coronavirus in general. That's considerably less of an issue when you're looking in the European and Asia Pacific markets. There's a lot more concern for other longer term threats, I guess, still percolating away there. And when you look at the top kind of concerns for Asia Pacific, yes, the financial market kind of recession and downturn and the pandemic still are the top concerns of the group, even if they are less concerned than in other regions. But I think it's interesting that there's still some key longer-term issues that are playing in here. So data breaches, data security, cybersecurity, that sort of thing, obviously still playing a significant role. So that's the one right at the top. I just wanted to highlight the one that the Asia Pacific concerns that kind of came to the top a bit. And then right at the bottom, right at the end of the chart, intergenerational wealth transfer. Still a concern, something that we've seen actually quite a lot of Asian wealth managers take to heart and actually be addressing in their strategy statements and new product launches for next gen programs and a variety of kind of measures around digital and all that as well. So quite an interesting mix, I think, for Asia, where in North America and all that, you just see them maybe still in a bit of panic mode about the recession and the pandemic, which is not terribly surprising, I guess, when you're talking about the COVID experience around the world. So overall, just kind of like to sum things up a little bit, Asia Pacific wealth markets not doing too bad, really, compared to other regions, with modest growth in the forecast. We still see, obviously, high net worth as suffering in the region, as we do around the region, across regions as well. And that's just really down to the greater exposure to equities that we do see in that portfolio. Of course, there's lots of illiquids in the high net worth portfolio as well, but when we're just focusing on the kind of liquids, they obviously have a greater exposure to the equity, mutual funds, that sort of thing, and less of a role for effectively it's just deposits that are providing that ballast there. In terms of the markets overall, didn't quite highlight it quite as much, But Indonesia definitely expected to be a growth opportunity still, just in terms of size and its expected ability to grow, holding up best, I guess, in 2020 of the markets around the region that we're looking at. Major private wealth managers, we do expect, just looking at their experience in terms of the wealth inflows and their ability to kind of claw back market gains over the course of the year since that end of Q1 kind of big drop that we all saw. There is basically an expectation amongst our kind of modeling that they will gain market share as a result of kind of a shift towards quality and a shift towards reassuring brands, which obviously those big beasts of the private wealth management market can provide, particularly as they are more stable than they were in the GFC. Some of the things that we didn't quite get into, but it also kind of relates to that big universal bank brand, is the fact that high net worth investors will probably require a lot more liquidity support and credit during the crisis and recession period of groups, particularly where we're looking at the more the recession kind of aspects right now. Just to make sure that they stay invested and open to the bounce and to the growth, and just recognizing obviously that there will be some short-term pain to be felt in everyone's businesses, and obviously that kind of aspect of the bank, not necessarily prioritized often by private wealth management firms. Obviously asset allocation and investment strategy is the key bit, but it definitely is one of those secondary services that are going to be much more in demand this time around compared to previous ones. So yeah, we are anticipating, I kind of waffled a little bit on whether wealth booked offshore will increase or decrease. We should see kind of a short-term decrease, mainly due to the fact that the U.S. With those disclosures just becomes a little bit less attractive as a place to book some cash, particularly in a election year. So we anticipate a slightly dip in that, but Asian booking centers, have riding a good wave, riding a good trend, and I think are well positioned to kind of like pick up any business that doesn't necessarily want to go to the massive U.S. market the way it once did. But of course, there is still a need, a particularly strong need for Asian wealth centers to increase their market share amongst Asian investors. Compared to other regions, a lower share of Asian wealth is actually booked if you're just looking at the offshore sector, booked within the region, and I think there's a lot of basically a lot of ground that can still be made up in terms of leveraging the capabilities within Asia Pacific. So that's the main strokes of the presentation. Hope you enjoyed. If you do have any questions, really happy to take any emails, and yeah, have a good one.